If what you thought to be true about mortgages turned out not to be true, how soon would you want to know about it? This actually is one of the reasons why I decided to make a career switch and become a financial advisor. I purchased a house when I was 26 and I had no idea the terms of the mortgage. I didn't understand the different types of mortgages that there were. I didn't want to ask any questions because I just didn't want to seem stupid. I wanted to kind of, seem like I was an adult. I'm 26, I'm buying my first house, and I didn't ask any questions. And I really should have because the mortgage that I chose was a horrible financial decision for me. And it didn't have to be had I had the financial education and knowledge that would have helped me make a better decision. So, one thing I do as a financial advisor, I've been doing this for 15 years. I help my clients make wise financial decisions. And in doing that, it's the difference between knowing a good strategy and the right strategy, right? Especially now, you're going to hear people on TikTok, people who have no type of financial education or background give financial advice and recommendations. And how do we know, what to choose, what's right for us? So my job is to make sure that my clients are making confident financial moves and financial decisions and asking any questions that they don't understand. There's no stupid question. When it comes to your money and some shit you got to pay for a long time, especially things that are large purchases that are really life altering, like purchasing a home, you want to make sure you understand. So, today we're going to cover what's called the mortgage master. So, let's say you're making money, right? You're making money and you have a choice of where you can put that money. It's not a trick question. I don't know why people think this is a trick question. They think, like, oh, I don't know. But let's say you have two places that you could put your money. You could put it in a box making 0%, or you could put it in a box earning 7%. Where would you put your money? And unless something's wrong, I think you would choose a 7% box. That's where I would choose if there's a choice to put my money, whether I'm going to make 0% or 7% all day, I'm picking a 7% box. People choose the 0% box all day, every day, and they have no idea that they're choosing it. And the way that people choose that box is with their mortgage in their home purchase. Remember when we used to, I'm probably showing how old I am, but when we used to draw houses like that with the roof, whatever. So people are choosing this 0% box because of kind of what we've been taught, what we've seen our parents do, what we've seen our grandparents do. And I saw my grandparents make moves that, coming up, they always had money. They always helped us with school clothes. My grandfather, he was an entrepreneur on the side. He retired early. My grandmother retired at 50. They traveled, they owned real estate, they owned land. So I thought they were pretty financially savvy, but they didn't teach and pass that education down to their children, my mom. And therefore, it didn't get passed down to me. But back in the day, and still taught today, one of the reasons that people are taught to have a mortgage and buy a home is for the American dream, right? Get married, get a house, white picket fence, two and a half kids, and you're living the dream. So we're taught that home ownership, when you own a house, is to have no mortgage, right? So when we're taught that, we have to understand what's the lost opportunity cost. And that's the lost opportunity cost. And so there's an opportunity cost associated with everything, but we're going to talk about what it has to do with your money. And a lost opportunity cost, it involves money that you could have made on that same money that you spent had you kept it or invested it somewhere else. So let's say you had $100 and you spent it. So the lost opportunity cost would be the opportunity in the future for that $100 to become $150 or $200 over time. So every dollar that you spend, there's a lost opportunity cost associated with that. So you want to make sure that you're making the best decision when you do that, because once it's spent, you don't get that money back unless you save or work or something in order to make that income come back in. But if it could have been growing and you delay the time that it could be growing, then that's the effect of lost opportunity cost. One thing to keep in mind when it comes to mortgages is your house is going to appreciate whether you have a mortgage or not, right? Like, let's say you have a house and a mortgage that's $200,000 right now. That's what it's worth. Well, the market could really run up and now your house is worth 400,000. And you didn't do anything. You didn't do any upgrades, you didn't add a pool, you didn't do anything to your curb appeal. It just happened to be because of the market. It had nothing to do with you. The equity in your house increased and the value went up by 200,000. So obviously, in this case, we're making equity. If you started with 200,000 and now your house is worth 400,000, then the equity that you have in your home is $200,000. That's why people buy houses and invest in real estate, because of that appreciation that could potentially happen. And if that's true, the opposite is also true. So your house could also depreciate by a certain amount of money that has nothing to do with you. So your house could be worth $200,000. The market could go to shit, which you never know with Trump in office and what he's going to be on next. But your house could then be worth 100,000. You got a mortgage and you're paying on a loan for 200,000, but now the market value of your house is 100,000, and it has nothing to do with you or any decisions that you made. You're paying your mortgage on time, you're being responsible, you're sending in the payment, and your equity and the value of your home has completely dropped. Don't believe this is true? Let me tell you, when I first became a financial advisor, I was working with one of my friends who became my client, and she had a condo that she had paid $120,000 for. And all of a sudden, the housing market crash happened, and now her condo was worth $60,000. I don't know why I'm putting a K on the hundred thousands, but $60,000 is what her house was worth. And she didn't do anything. And that was crazy to me because it really let me know that the value of your home and the equity that could be built up in your home really has nothing to do with you. So, what I like to ask you and for you to consider is, who is in control of your money? And you might think, first off, like, I'm in control. Like, I work, I put my money in the bank, I pay my bills, I buy my car, I buy my house, I pay for this. I'm in control of my money. But let's see who's really in control. So let's say you keep on paying your mortgage and you pay it off, right? You've got that $200,000 mortgage, you've paid it off over time, you've sent in extra payments because you didn't want to have any debt. Now, a lot of people kind of make that decision when it comes to money because they don't like debt, right? It stresses them out, they can't sleep at night. Now, there's a difference between good debt and bad debt. That may all feel the same to you, but it's completely different in the opportunity cost and how you should view it, right? So, one of the things about a mortgage is it's good debt. It's good debt because you have the interest deductions, you have potential to build equity. Your student loans are considered a good debt because, and that may not feel like it. I've had clients who've had no debt, little to no student loan debt, all the way to $550,000 worth of student loan debt. So, the way that you look at good debt versus bad debt is the ability for what you can gain on that. So, had you not had your college degree or had some of that student loan debt, you may not be earning the income that you have. And anything like credit cards, personal loans, those eat away at your ability to earn money and build wealth. So, I call that cancerous debt because, again, it eats away at your ability to grow and build wealth. But back to our example, let's say you are diligent, you're sending in extra payments. I see a lot of times on threads, people are like, oh, a few payments away from paying off my mortgage. I have one more payment, or we're sending in this amount of money so that we can hurry up and pay our mortgage off early. So let's say that you do that and you have no more payments. What happens when you do that? When you pay off the house, the bank is going to give you a deed, right? Great, here's a deed. I don't know what a deed looks like. I don't know why it looks like a person, but I was trying to make a little seal. I'm not an artist. I know money and numbers, but you get the deed and you have no more payments. So you own the home, right? You own the home, and then you have an equity position in what you could sell your house for. So in our example, let's say you had $200,000 that you paid off, and now your house is worth $250,000. So you have made $50,000 in equity. But how much have you earned on that equity? The equity, that $50,000 is earning you 0%. The reason why I know it's earning you 0% is because once you have no mortgage and it's paid off, your bank, they're not sending you a dividend check each quarter or annually. So it's 0% that money is earning. Now, for the sake of argument, let's say you're 40 years old. Now, depending on how old you are, that may seem like an extensive time away or like a long period of time, but trust me, 40 will be here quickly. So let's say you're 40 and we want to calculate or estimate what we think the life expectancy is for you right now. So if you're a 40-year-old female, let's just say the life expectancy is 80 years old. If you're a male, y'all be doing crazy stuff, so your life expectancy is a little lower than that. But for this example, you're female, you're 40, or you can choose if you're male, you're 40, and your life expectancy is 80%. I mean, to 80 years old. So for the purposes of this discussion, let's say your lost opportunity cost is 7%, right? Because in our example, we had our boxes, we could put our money in a place earning 0%, or we could earn 7%. So our lost opportunity cost, if we're not gaining that 0, is 7%, because in this example, that's what we could be earning. So the rule of 72 states that, and make sure you're taking notes and put them in the comments. Rule 72 states that for any given interest rate, in our case, 7%, divided by 72, that is how long it will take for your money to double. So in this case, 7 divided by 72 is 10, so it's going to take 10 years for our money to double. So from our 40-year old self to our 80 years old self, that is 4 10-year periods, right? So let's look at the equity again. Equity is considered an asset, right? If you had equity, you would look at it as an asset. So let's put it down here. So you got an asset of $200,000 versus your liability. So let's say you want access to this asset. You want this money. There's only two things that you can do to get access to that $200,000 in equity, or in our case, the $50,000 in equity. But this money, in our example, $200,000. The only way that you can get access to that is you can refi, right? You can refinance. And if you refinance, you got to go to the bank, you got to fill out an application, you got to get permission to use your own money, and they're going to ask you for your most recent W-2s or your tax return. They're going to ask you for your pay stubs. They may, I really write much better than this. I don't know why it's looking so sloppy, but they're going to ask you for your pay stubs. They might even ask you for, let's see, tax return, pay stub. Yeah, that's what they're going to ask you for. You're going to have to fill out an application. And you're going to have to get essentially permission to use your own money, right? And not only do you have to get permission, but then you have to pay to have access to your money and borrow your own money. So anytime that you have to fill out an application or you have to ask for permission, that's a sign that what you're asking for is not yours and it doesn't belong to you, at least not in the way that you think, right? You are not in control if you have to ask for permission or fill out applications and get approval. Now, I remember when I wanted to be 18 so bad because I'm going to be grown and can't tell me nothing, can't ask me nothing. I'm going to do what I want to do. But in a black house, we already know you're not in control, 18 or not, as long as you're under that roof. So the same rule applies when you have to ask for permission, you have to fill out applications. So you don't own it in the way that you think. But once you pay off the money to the bank, what is the bank doing with your money? Bank is only in the business to make money. So you paid it off early. They're grateful for you. They're taking that 200,000 and they're loaning it out to other people. So they're making money on what you're sending them to pay off your mortgage, which that's what they should do. They're in a business to do that. And what are you doing with the equity if you have no mortgage? It's just sitting there. So my question to you is the house a good place to park your money? Is it a good place to have your money tied up? Now, I do believe that there's a difference between having your house paid for and paid off. And I'm going to show you the difference as I move forward through this. So let's look at your other option. And this is real life. I had a client who had put a large down payment down on her condo and she was purchasing it. And by that thought process, you would think there's a large amount of equity. She put down six figures, so there's at least six figures worth of equity in the home, she would hope. Well, she decided, I want to do some renovations, I want to travel and get some access to the money. I'm going to refi. So she calls up the bank. The bank's like, nah, I'm sorry, miss, but this thing called COVID is happening right now. We don't know what that's going to look like. We're not loaning any money. We're locking the money. I don't know when you can refi, at what rate you'll be able to refi, if we allow you to refi again, but you can't access that right now. And that was crazy to me because in any other situation, if you knew that you had six figures in the bank and you were like, let me go make a withdrawal so I can take a trip or whatever, it doesn't matter what you want to take the money for. And the bank person was like, yeah, we're not going to give you that withdrawal right now. We're going to go ahead and hold on to that. We don't know what's happening in the market. I don't know about you, but y'all would have to call security for me because I want mine right now. It's my money. I want it now. But anyway, again, she was not in control of the money that was hers that you would think she would rightfully be in control of. So if you don't refi, let's look at one of the other options that you can do. You can sell it if you want to get the equity out. So if you sell the house, then what happens? You got to get a realtor, you got to pay 3%. The buyer's agent is going to want 3%. The seller's agent is going to want 3%. And in our example, that's $12,000 that you would have to pay just to access your money. And if you had $200,000 in any other type account, say a savings account at the bank, and you want to access it, but you were forced to pay $12,000 to get it, how would you feel about that? Again, go ahead, call security because we got a problem. But that is what's happening every time you accelerate your mortgage payments, you pay that off, and you hurry up and get free mortgage free and clear. There's a lost opportunity cost as well. Again, we talked about that. So in our example, let's say we said we're 40, right? We're 40 years old. What the hell? Let me fix that. 40 years old. And we're going to 80 because that's our life expectancy. So let's say in that time frame, your 200,000 will become 400,000. That's our first 10 years, right? And then our next 10 years, our 400,000 is going to become 800,000 based off of our rule of 72, where again, for any given interest rate divided by 72, it'll double in a 10-year time frame. So in our example, we had 7%. So 10 years here, we've gone from 200 to 400 to 800. That's 20 years at 800,000. From 800,000, now we have 1.6 million in our 10-year time frame. And after 1.6 10-year time frame, that's 3.2 million. So your decision to pay off your house It didn't just cost you the 200,000 that you assumed of what your mortgage payment was. It really cost you 3.2 million because that's what you could have earned in those 10-year periods from age 40 to age 80 if you were getting that 7% in that 7% box. That's crazy. Do you think at the end of this 40 years that we did that your heirs will be able to sell your property because you're gone and make $3.2 million from it, from the sale of it? Maybe, maybe not. But is that a gamble that you're willing to take? If you could put that 200,000 or the accelerated payments or the extra money that you would spend to pay your house off in another account earning 7%, you have the potential to have $3.2 million. Not only would you have the potential to have access to $3.2 million, but you would have control of that $3.2 million. The $3.2 million in another account, you would have liquidity, which means you can go right there and get it out like in your checking account or savings account. So what I'm able to help my clients do is gain a portion of that $3.2 million while having their house paid for at the same time. So what we want to do is put together a strategy that would allow you to gain 7.2%, 7% on your money and have enough as time passes, as your money compounds, to be able to have enough to have your house paid for in 5 to 6 years. It's completely possible. It's completely doable. And then at that point, you have the choice whether you want to write the check to pay the house off or not. So, financial peace of mind is in my book. Everybody has a different idea of what it means to be financially free and having financial peace of mind. But in my book, it's knowing that your assets exceed your liabilities. And when that happens, you have control. You have options. You can make any decisions that you want to make. And most people think that financial peace of mind is having no liabilities. They want to get the liabilities out of here. They don't want any debt. But then zero debt and no cash or assets is not going to get you very far. Because once you pay off that $200,000 mortgage, you got to start over. And that's a topic for another day. There's a few reasons that people want to have a mortgage. And again, one of those is the interest deduction that they'll receive on that. If my mom saw this penmanship, she would have, I grew up where we had to write in cursive and they did not play that with your penmanship. You better be on point. But whatever, I'm grown and I'm writing on my iPad with my pen. So this is what you get. But you want to make sure that the decisions that you make financially are putting you in control. So, one of the ways to do that, again, if we are gaining what the hell? If we're gaining 7% in our box and we have a 3% mortgage, there were days where we had 3% mortgages and even less than 3%. Well, there's a spread that you're picking up right there, a spread of 4%. Or fancy term that I like is arbitrage, is the difference between what you're gaining and what you're paying. So there's 4% that you're picking up on that when you pay that money off. So we're not completely in our 0% box and we're getting that 7%. And the difference between what we're paying and spending our interest on and what we're gaining is our spread, which is 4%. So just so you know, this ain't some shit that I made up and it's just not my opinion. Like I've walked you through the money sense and the money mindset behind it so that you can understand. But Two of the richest people in the world, and it's probably more people by now, because you'll hear a lot that celebrities are, they bought this cash and they paid cash for this. And they're usually doing that with capital for capital purchases. And a capital purchase, in my book, is anything that you can't spend your monthly pay to pay for. So let's say every month you earn $5,000. Well, anything over $5,000 is going to be a capital purchase. So typically, cars, weddings, houses, those are capital purchases, college. So, how you pay for those matters again to that lost opportunity cost and the control. But two of the richest people in the world have mortgages. And it's crazy because they could essentially pay that mortgage off and never ever feel it in their pockets financially, right? Their kids wouldn't feel it, their grandkids wouldn't feel it, nobody in their lives would feel it. But the last time I checked, I don't know, I think Mark was worth like 60 billion or something crazy. But Mark Zuckerberg from Facebook and Bill Gates, they both have mortgages. And the reason why they have mortgages is because they're able to pick up that spread. And yeah, they can spend $10 million to pay off a home and not affect their lifestyle, not be hungry, not have to make peanut butter and jelly sandwiches in order to do that. But they also know by doing that and paying that off, they're giving up the opportunity for their money to gain that 7% interest in our example. So why would they do that? Why not pay a mortgage on 10 million at, let's say, 4%, and get that 7%? And the difference between that again is a 3% spread. So I don't really care which one you do, like one way or the other. But what I do care about is you understanding the impact of those financial decisions and whether those financial decisions are really something that are going to serve you and serve you well over time. Think about it. In order to refi, again, you have to ask for permission. You're not in control. Let's say you've lost your job and you need money and you know you have $100,000 worth of equity in your house. Well, if you lost your job, you have no pay stubs that you can show. You have a tax return maybe from an old one, but there's no income. And the bank is going to be like, I'm so sorry, but we can't loan you your own money because you have no means to pay it back. And this is a real life example that I'm dealing with one of my clients right now. They have a home that is free and clear, paid off. It's worth $800,000, and they have no income to be able to refi to take money out of it. The house is passed down. They don't want to sell it. They want to keep it, but what are you going to do if you don't have any money to be able to access that equity? The only thing that they can do is sell it. And they don't want to sell it because it's sentimental, it means something. They want to keep it in the family. But these are real life examples. Last example, just to kind of drive this home to what this could really look like and the impact of the financial decisions that were made. Because again, a lot of us are just doing shit that we heard. We have the financial gurus that are telling us to do this with our money, put your money over here, pay your mortgage off, get the 15-year mortgage, do it as quickly as possible. You got your friends doing this, your grandma doing this. But when you really look at the numbers do not lie. I had a client, she was 80 years old. No, she might have been like late 70s. Either way, she didn't have any children. She didn't have any grandchildren. She wasn't married. She was divorced. And I was helping her. I was taking her to her doctor's appointments and taking her to lunch and stuff sometimes. So one day I was over there to take her to an appointment and I had to go to the bathroom. I was like, oh, I need to go to the bathroom. She's like, hold on, I'll be right back. So she ran down the hall and she came back and she was like, I had to flush the toilet. And I was like, okay. She was like, I just go on top of the toilet all day and then I flush it at the end of the night or the next day because it's expensive and it costs a lot of money to flush your toilet, the water bill. And I'm thinking, how much pee are you using daily to really make a difference in your water bill every time you flush the toilet? But you know what she had going on? She had a paid off mortgage in San Diego. So just at like $1 million was the value of her home. She owned it for over 30 years and she was afraid to flush the toilet because of her water bill going up. She was on a very, very fixed income and she had hundreds of thousands of dollars sitting in her home that she couldn't didn't have access to. I know you could say, well, she could do a reverse mortgage. We're not talking about that. We're talking about the two options that she had available to her: refi, which again, on a very fixed income, she can't prove that, can't afford that, because if she wants to borrow $500,000, she's got to be able to prove that she can afford to make the payments back to 500 for $500,000 over time. Very fixed income. And if she sold it, there was nowhere else for her to live. I guess she could have sold it and then rented. But again, you see the point that I'm making, and the ability to have control over your money, to have your home paid for, and to have control over your money and have liquidity and have access. And think about the people in your lives. Think about your grandparents. Think about your great aunts, your great uncles, people who have their homes paid off, and look at what their lives really reflect that. And typically, what happens after they pass away, depending on how they structured the property, somebody's getting it, the grandchildren, their children, they're selling it, and they're losing that anyway. And without the right financial education and literacy, all of that money is just lost. So, again, there's a difference between having things paid for versus paid off. And one way gives you, makes you feel secure, but one way actually gives you control and puts you in full security.